Given that we are famously as a country really good at discovery, good at research, good at innovating, and not very good at scaling to global commercial impact, I wanted to ask three related questions. Firstly, the bank's model. Do you see yourselves, are you there to take more risk than existing private sector investors? So is it a market failure gap, or is it about the way in which you invest? I'm just intrigued as to what your operating theory is. Secondly, what in your view is the failure in the UK ecosystem? Is it that our companies are too geared to be too small and academic, or is it just lack of capital? What's the thing that you would, given your expertise, want us to recommend government do to try and tackle it? And then thirdly, on Mansion House, do you support the notion of the mandate, of mandating, if not how, then at least that a greater percentage of UK pension funds should go into high-growth companies?
Great. So three questions there. In terms of our operating theory, we have some programs that have some element of subsidy that by definition should be taking more risk than those which are purely commercial, and we have commercial programs as well. The British Growth Partnership we talked about before is purely commercial. It has no other element of additionality other than it's seeking to get UK pension money into the growth economy. In between, we have a range of additionality requirements around regionality, around the stage of company, around backing innovation, around realising potential for entrepreneurs around the country, whoever or wherever they are. We have strong risk appetite, but we seek to mitigate that risk through a variety of techniques, and actually to convince others that those techniques really mitigate their risk, because the perception of small business investment is that it's highly risky, and our view is that if you are diversified enough, it mitigates a lot of that risk. It doesn't mean that there is no risk, but small businesses come in many different shapes and sizes. Some are innovative, and there is real technology risk around them. Others are high street businesses with well-proven business models elsewhere that are properly important to communities and properly important to the economy, but aren't necessarily innovative and risky in that way.
And if I may just add, Kristen McLeod, I'm the bank's Chief Strategy Officer. The other thing that the bank can do in a fully commercial way is look for bespoke measures where we can fill sector-specific gaps. So two really obvious examples are the LIFTS programme that we have run, and also the Life Sciences Investment Programme, where we've specifically looked at gaps in the economy and tried to fill them in a very specific commercial way.
Could you say a little bit more about the LIFT programme?
So the LIFTS programme, long-term investment for technology and science. The bank was asked to put out a tender for proposals from the private sector to manage some money from the bank alongside some money from ideally DC, defined contribution pension schemes in the UK, for investment in UK tech and science-led companies. Last summer, I think it was last summer, or certainly by November last year, we concluded that transaction. Schroders are the manager. We put in £250 million alongside £250 million from Phoenix of their DC pension money. Investments have started, but the idea is to try and increase the DC pension contributions there up to make the whole fund about £1 billion.
Okay.
In terms of your second question, Mr. Freeman, in relation to what the issue is, what the failure is, I think there's certainly there's a range of failures here, but certainly there is a lack of capital. But the lack of capital is not a lack of an amount of capital. We have one of the best funded pension schemes in the world, the second best funded pension scheme in the world, yet it really isn't focused on investment. And I think that the fundamental issue there, I contend, is around the risk appetite in a manner I discussed just a little earlier on. And were we to have a greater risk appetite, in a way that there appears to be greater risk appetite in the US, for example, we would see a lot more of our innovation backed by our own UK institutions. As it is, we see a significant amount of capital properly coming in from the US, from venture capital funds there. We don't want to exclude that, I don't think, but we do want some kind of a domestic counterbalance to that capital. Otherwise, the companies that we've incubated, at the point they need to scale up, tend to gravitate to where their capital came from, and they tend to be lost to the UK economy just at the point they become economically significant.
And if I might just add on the point of international comparisons, our latest bank research shows that the gap between the UK and the US on an overall basis has narrowed on a GDP adjusted basis. So that does speak to the impact of some of the bank's operations since 2018. But the really interesting point that we need to have in our mind as we think about the next 5 years is there's still significant variation between sectors. So if you look at fintech, we actually outperform the US, raising twice as much investment.
Yes,
whereas if you look at life sciences and deep tech, there's still a really deep difference.
And I think that, part of the issue around risk appetite is that at pretty much every round stage of fundraising, we've done a comparison between UK and US companies. US companies tend to raise around 2 to 3 times as much as UK companies. So I think that whilst there is an issue with risk appetite on the investor side, we do need to make sure that the ambition of our entrepreneurs is not suppressed by that lack of institutional risk appetite as well. And then I think your last question, Mr. Freeman, was around the Mansion House reforms and whether there should be mandation of UK institutions to invest in the UK. We feel that the opportunities in the UK are strong enough commercially on their own to warrant investment. And whilst it's important to incentivise and not to disincentivise investment in the UK, it feels like the government maintaining the threat of mandation without ever really using it might be the optimal way to go.
Right, thank you. Can I just, Chair, if I may, just to follow that up, because if you're right that actually our companies have got every growth potential of American counterparts, but the big difference is really the scale of money. I mean, it's an interesting theory, that, because it could also be size of market. To go from the UK into the big markets, you have to leave the country. There's a friction, there's a tension there. You've got to be an internationalist, you've got to be global, whereas in America you just go state by state and grow. But accepting your thesis that the big difference is scale of capital. And risk appetite is, of course, a function of scale, isn't it, as well? And wouldn't the argument be, look, we've gone from 50% of UK pension invested in the UK in 2000 to 4. The Mansion House proposal under the last Chancellor, I think, set a pretty mediocre target of getting it to 2.5. We're not even there yet. What would be the argument against the government saying, look, come on, by the end of this decade, we've got to be back at 5% or 10%?
Well, there are ways to achieve that without actually mandating investment. So I think that the Chief Executive of M&G in January was in the Times talking about how every one of us, when we contribute into a pension scheme, gets that out of pre-tax income. So there's a tax benefit, and therefore if your pension manager isn't investing at least some of that in the UK, maybe that tax benefit should be clawed back. So you don't have to invest in the UK, but if you do, there is a consequence to that. And that is not mandation, but it would be a strong incentive. And I think to your point about the scale of ambition of UK companies and scale of capital, I think it is really important that we do encourage our entrepreneurs to have an internationalisation element in their business plans from the get-go, particularly for innovative companies that are seeking to spawn technologies that have global application.
Thank you.
Okay.